panelist, and that is Mark P. Bernegger, and he's on the advisory board and ambassador at FinLeap, Switzerland. We also have another wonderful panelist coming up, and he is Patrick Lowry, and he's the venture capitalist and investment advisor, as well as CEO at Iconiq Lab. Welcome.
Thank you.
The next panelist we have coming up is Jan Brzezek, ex-UBS banker and innovation expert.
Hi, everyone.
And then we also have another panelist who might be a little bit late, Joel Dietz. He's not there yet, then he'll join us later. Okay, then let's go with the next panelist. We have Renqi Shen, and he's a digital asset investor and part of the Fenbushi investment team, blockchain and IoT ventures. Okay, I think we're complete.
Great,
let's go.
Thank you. Let's all have a seat. Perfect. Well, first of all, thank you very much to our esteemed panelists for joining us. The topic for today is getting blockchain investments mainstream. And I think in terms of our panelists, we have a very diverse mix of backgrounds. So I know we just gave a quick intro to each of them, but it'll be helpful if we just sort of go through quickly how you got into blockchain and when you got into blockchain, just so the audience has a bit of a context as to sort of your path in the industry. Mark?
Yes, hi, my name is Mark. I'm originally a tech entrepreneur. I co-founded and exited 2 tech companies, and since then I'm mainly active as an investor. Since 2010, mainly fintech, and in 2012 I was lucky to move into the Bitcoin space. So since then I'm involved in quite a few crypto projects, among others. I'm one of the board members of the Crypto Finance Group. I'm one of the co-founders of the Crypto Finance Conference, and then I'm involved in a few other crypto-related projects, and I think it's an exciting time we're here.
And when did you get into the space?
2012.
2012, wow.
Some time ago. So my name's Pat. I'm the CEO of Iconiq Lab. My background is actually an auditor at PwC, one of the only accountants, I think, in the entire crypto space. Did the audits of private equity, mutual, and hedge funds. Transitioned to work into private equity for a few years, which is about the time that I met my now German wife, and that's how I ended up here. When I moved to Germany, I started working with Deutsche Börse's venture capital team. And at Deutsche Börse, being the German stock exchange operator, we were looking at blockchain tech that we could invest into that could be integrated within the Börse's client offerings. But what happened is some of the companies that we would be submitting LOIs to turned around and rejected them probably about mid-2016 and said, you know what, we're going to do an ICO instead. And that's kind of where I threw my hands up in the air and said, what the hell is happening here? Why are these companies that are not native cryptocurrencies, not blockchain protocols, doing a token offering? So I started to dive into the space and started to convince myself that there is a use case for tokenization as a means of alternative financing for some, not all companies, double underlining the some there. And that's where we launched Iconiq Lab. So I've been in the space since about 2016 with my very first Bitcoin investment in 2014.
Wonderful.
Hello, everyone. My name is Jan Brzezek, and I'm CEO and co-founder of Crypto Finance Group. I'm coming originally from finance. Used to work for UBS, first in trading, and then as business manager for the head of the asset management division. That's how I got into the topic, because UBS did several projects on the blockchain. And we had to come up with an idea what we could do in asset management. And I said, let's set up a crypto fund, a regulated, proper set up crypto fund. And the EC then decided that there is no demand, no client demand for that. That's why I resigned and founded Crypto Fund AG. Then I realized that there is no execution, no prime brokerage parties out there. So I founded then the Broker AG. We set that up. It's live since November. We provide best execution for banks, asset managers, family offices, and so on. And then the third company we built recently, last year, was crypto storage, where we store cryptos for institutional clients as well.
So you got into the space in
2016.
Okay, thank you.
Hey, I'm Renqi. I'm partner at BlockAsset, a venture capital fund domiciled in Singapore. We're part of the Fenbushi Capital investment arm. And I got into crypto in 2013. I researched into Bitcoin, very fascinated with the technology, and then I invested into Ethereum and was an angel investor up until now.
Wonderful, thank you. And just to get a quick sense of the audience in here, how many people in the audience have invested in any crypto, any blockchain investments? Okay, that's 70–80%. How many have invested since 2016? A little fewer. Okay. So I think that to set a little bit of context, we can see that we're talking about getting blockchain investments mainstream, and you're kind of seeing a trend that more and more people are getting involved into sort of the blockchain investment space. And I think the ICO boom of the past year, since 2017, has really attracted a lot of new capital into the market. But sort of getting back to the topic for today, I think it's important to sort of first define what we mean by mainstream, because obviously most people in the room have invested in some form or another in crypto. So we're also at a time when sort of a lot of people are aware of blockchain investments. Goldman Sachs is opening their crypto trading desk. NASDAQ is thinking of getting into crypto exchanges. So I guess I'd like to first start by asking our panelists today, what is your definition of mainstream? Are we mainstream right now where people are aware of it and large institutional banks are actively pursuing it, or sort of will we get to mainstream when people actually start using some of the apps that are being promised by these token sales? What's your definition of mainstream? Maybe start with you, Mark?
Yeah, I mean, when I look back in 2012, and I was not doing it for speculation, I just wanted to understand how this new Bitcoin thing is working. So it was not so easy to get Bitcoin back then, but it was a very small group, mostly geeks, mostly anarchists. So it was a completely crazy community, and it's still part of the whole foundation of this whole crypto revolution. But back then, it was far away from mainstream, right? And now I think we see the classic development you have, and that's very unique in the crypto space. You have a lot of speculation, which is personally not a driver which interests me, but it helps to have this extreme and fast growth. But it's now also you have a lot of corporates joining the game, a lot of traditional financial service providers, and then you have the masses mainly speculating with it. And most of them will lose their money, I think. But that's always part of it. So I think we already reached this point. The question is when it becomes mainstream and also relevant. And relevant means when you have real use cases really changing and disrupting existing business cases and value chains. And that's something I think we're still waiting for.
Yeah. I think we have to segregate mainstream into two buckets, one from an investment side and then another from a use case side, exactly as you said, Mark, where we have to look from an investment side, well, what do we define as mainstream? The larger traditional institutional capital, the trillions in private wealth management coming to this space to really push this to the next evolution of what we have. Because at the end of the day, this 250 billion market cap, I think that we have it this morning, is relatively cute, but pennies compared to the capital that we can bring to the space. Or from an investment side is mainstream bringing a real retail element to the space. At the end of the day, because this is supposed to be decentralized, I believe that that's when we can really start to see some mainstream adoption, and we can bring both the institutional partners and retail investors to participate in this development of these early stage protocols and companies together. From a use case standpoint, this only goes mainstream when a ICO actually delivers on what they're claiming that they're going to do. And there's very few out there that are doing this. But until those use cases develop, until they evolve, and until you actually have users that are participating within the ecosystems that these TGEs, token generating events, are accomplishing, you're not going to see mainstream adoption for this. And because you won't see mainstream adoption at the retail level, it's going to be very difficult to ingrain this with the incumbent institutional players that are part of the traditional marketplace. And until that happens, I don't see this as mainstream. So it needs to be about getting the investment on board, and this is probably going to be more a regulatory question than anything. And then the second aspect of this is getting the use case involvement on board. And this is holding companies to a higher level of accountability to deliver on what it is they're promising from the financing they raise.
So yeah, and you come from an institutional investor, institutional financial background. Do you agree with what Pat just said, sort of from an institutional standpoint?
Yeah, I think I can take a look at it from an investment perspective, right? So there are three prerequisites. One is regulation, as you just mentioned. We need to know, or banks or investment companies need to know what they're exactly doing, that they're doing it in a proper regulatory framework. The second one is access. So it's not you cannot bring it mainstream with having to open accounts at crypto exchanges and trading your own money there. You need to leverage existing financial infrastructure, so banks, traditional exchanges and so on, investment managers through funds and so on. And then the third pillar is custody, or another prerequisite. Even you're able to store your cryptos yourself. That's the same with cash. You can store cash with yourself at home, but are you willing to? Are you willing to take the risk of losing that? No. So small amounts are completely fine that you can store it on your mobile wallet, but if larger sizes, you need to have a custodian who has a professional setup to store the funds for you.
Mm-hmm. So I think you actually framed it very well with kind of three key points: regulatory, access, and custody. Let's start off with sort of talking about regulatory aspects. I think there's a lot of talk these days about whether or not it makes sense to have more regulation or less regulation. On one hand, I think some of the anarchists that you spoke about from 2012, a lot of people got into Bitcoin, got into blockchain because they see this as a libertarian way to sort of reduce their reliance on governments. On the other hand, I think from an access point of view, most people, they still need to sort of, in order to get into this market, they still need to rely on a traditional sort of financial infrastructure. They need to go from fiat to crypto and so forth. So do you think to actually get blockchain mainstream, do you guys think more regulation will be better or less regulation will be better?
It's the right regulation.
Yeah, it's modern regulation. It's not necessarily about over-regulating anything like what we currently see in the banking institutions, and it's also not about taking a hands-off, laissez-faire approach towards regulations. There needs to be a more modern approach to how we look at regulating this very new digital asset class. Because at the end of the day, what regulators have is buckets of multiple different types of areas that they'll classify a security, a currency, an instrument, digital good, or a service. But that is very stringent because there's only those existing buckets. What we need to do is work with our regulators and work with our politicians to redefine new buckets that we can classify these instruments into. And only by doing that, because at the end of the day, tokens are only limited in their use case by human imagination, then we can properly create a framework through which regulation can flourish and then bring that mainstream element to the crypto space.
I guess I want to peg to what Pat said. I think to make cryptocurrency mainstream, there's a lot of factors and elements which we've already discussed. But I think, in the day, we've got to make sure that the regulators are comfortable with this brand new asset class. And how do we empower them to do so? So one of the things that we're exploring at BlockAsset is financial inclusion, which is helping out, lend a reaching hand, people in these bank regions, and access to a bank account, identification, and so forth, these bare minimums. And that way, when the regulators see that cryptocurrency and blockchain is for good, they will be more inclined to jump on board. And, it will make everybody's life so much easier.
I think also you have, different perspectives, right? The underlying technology, blockchain, and like every other technology, is completely agnostic. Technology is not interested in politics, right? But the interesting fact here is that with all this cryptocurrency frenziness, you have one of the main use cases, I would say at the moment, it's the main use case, is digging quite deep into our existing financial services global network, right? And that's also one of the reasons, you just mentioned it, it's one of the most regulated industries, and you have this libertarian way and the technology which literally could disrupt the whole system of compliance and regulation. And I think that's why we have this very unique situation where a technology just invades a certain industry. And it will be interesting how governments try to, on the long term, also to regulate a phenomenon which is based on a new technology.
I think that's very important as well. Regulators think in buckets, as you said, right? You have the different kind of assets, and they're trying to categorize cryptocurrencies or the crypto assets. For them, everything is one, so they try to find the right bucket, and they really struggle to put it somewhere. That's why I really like the approach of FinMOF, the Swiss regulator, that they came up now with a first guideline, and they are not regulating it and putting it in one bucket, but they came up with 3 different buckets. So cryptocurrencies or currency tokens, utility tokens, and security tokens. And then you have, as an ICO, you have to define what it is. And then you can kind of put it in one of the brackets.
Yeah, I think that there's kind of a unique balance between like more developed economies where you have a lot of existing legacy legacy regulations that it's sort of regulators' first instinct will be to try to fit it into one of their existing buckets, but you really kind of need to push them to really create a new category for this. And on the other hand, sort of what Renqi brought up earlier, that maybe some of these use cases they're going after developing countries, places where there's not as much legacy regulation, where you have the opportunity to use blockchain to really access the unbanked, the uninsured, the unserved populations, where there isn't even any legacy regulation, and there's an opportunity to actually sort of create a new regulatory framework. And you see places like Estonia, like Zug, like some of these places that are really sort of trying to reinvent their whole government regulatory structure to really fit into some of these new technologies.
The only comment I would make to this, to kind of close the regulatory aspect, is that at the end of the day, you're still going to have bad players in the marketplace. So I understand the native technologist and native cryptologist mentality towards having a full libertarian angle, that we don't have to rely on government at all. You have very interesting in crypto individuals that are more on the full regulation side, and then kind of the burn the government anarchists. There needs to be a happy medium that we're able to settle on, and that's only going to work through education, through working with our regulators, and redefining what those buckets are, exactly as the Swiss government's been able to do.
Okay, I think that sort of this actually provides a segue, because when we talk about regulators, right, I think a lot of the focus right now is on sort of financial regulators. But as you mentioned earlier, really kind of the potential use cases of blockchain, of crypto, are basically beyond anything that you can dream of right now. So in a way, from the regulatory standpoint, like which regulator actually touches this project also depends on what exactly the use case is. And given that there are so many sort of potential use cases that a lot of these projects, these apps, and even sort of commercial enterprise blockchain applications are going after, I wanted to get a sense of what you guys think will be kind of the first breakthrough use case, the first killer app of blockchain in terms of a lot of these investments that you're seeing.
I mean, I would say ultimately it's the government which could be replaced in certain areas, and not because I'm against governments, but just because it makes more sense to have a far more efficient and transparent technology-based solution for quite a few interactions in a traditional government. And I think that's also one of the reasons why it will be very interesting to see how politicians react, because ultimately part of their job could be in a very good manner replaced by this new technology. That's perhaps not the traditional investment case, but I would say on a long-term perspective, that will be one of the most fundamental impacts of this new technology. I think that will take some more time.
I think it really depends on the country, right? So with cryptocurrencies, with Bitcoin, that's not a competition for the Swiss National Bank, for example, because they're very stable, they do a good job. But it's a different story for Venezuela, Brazil, Zimbabwe, and so on. So where you have a high inflation rate, and then people started, before people converted into US dollar as fast as they could, and now they're starting to move into Bitcoin. So it will become a real competition to a central bank issued currency. But it really depends on the country, I think.
Yeah, and I also meant one level higher. So not just the currency, really you buy a house, then you go to the notary service and he puts his stamp on it and gets a 0.whatever% fee for it. And because we need the trust of this notary service, we rely on that. I think it's obvious for everybody here in the room that that's something we can really replace by a technology like blockchain, and it has to be replaced. But if I would be a notary service person, I also would try to preserve the status quo. Right?
Yeah, I mean,
so why hasn't it been? I mean, I think notarial services, and you've been in the space since 2012, I think people have been talking about replacing notarial services since 2012, 2013. Why do you think that hasn't really taken on in the past few years?
Yeah, I think one of the reasons is just that there is not enough knowledge in the relevant heads, let's call it that way, that you could really implement and you really see the power and impact of this new technology. But I think that will change. But honestly, how many politicians really understand the power of the blockchain technology? I mean, honestly, who here in the room, including the panel, really understands all the details of the underlying power of this technology. So I think it just needs
Well, let's
some more
define what
time.
blockchain is at a high level. A blockchain itself is nothing more than secure, immutable data storage. That's it. We can call it Web 3.0. We can come up with any buzzword that we really want to throw at it. At the end of the day, it's just secure data storage. Now, what can that do? Well, basically, that's going to be able to penetrate any infrastructure in every vertical within normal industry, because it's a redefining of the transfer of that data. And that's really what blockchain's use case is, and that's what it represents. So to answer your question, which use case, which vertical do I see blockchain from a use case perspective disrupting? God, throw a dart and hope to God that you stick with something, because your guess is as good as mine. It could go from logistics to healthcare to investments to infrastructure to real estate to everywhere in the world except for Germany, because the notaries have way too much power here. Unfortunately, I know this too much so. But it's a redefining of the infrastructural rails of data transfer, which is what the web represented in the early 90s. We now have the really good use case to secure that data and to truly be able to trust it with the decentralized node networks that we have processing those transactions. And that's what we have with blockchain.
So I guess that's what I'm getting at, right? I mean, some of these industries you mentioned, like healthcare, like supply chain, like financial services, these are all highly regulated industries, and one could argue that it takes a long time to actually get the regulators on board. But on the other hand, you have some other use cases, like, for example, video games or even like social networks or something like that, where there isn't really that much regulatory touch point, but yet sort of over the past few years, those use cases haven't really gone mainstream or haven't really built up. And it seems that the barrier there is not regulation. So what are the barriers for some of these other less regulated use cases to really get mainstream?
Well, but it's interesting because in emerging economies where there isn't really that regulatory infrastructure, the banking and the healthcare do actually have an ability to scale, which is why I've always said the best use case for blockchain technology at its core is in emerging economies, where these highly regulated industries that we have in the West, you can displace all the current infrastructure that currently exists there to really scale this technology infinitely farther in these emerging economies.
So I think for, I'm just going to spill it. So I think for a use case that really makes sense right now is how do we get mainstream investors or retail investors getting to crypto? So it has to be an easy gateway to get in. And then how can we make this crypto spendable? So you can go to the grocery stores, buy, a pineapple or, buy a coffee or whatnot. So that way, it's actually real, right? So cryptocurrency, to a lot of people that I speak with, they don't really understand the technology. They probably don't even care. They just want, to know that this asset class is either going to generate them money or they can use it for something they need. So I think say projects such as 10x or Pundi, where they allow cryptocurrency to be spent in the store, will sort of accelerate making cryptocurrency more mainstream.
So going back to this point about sort of emerging markets, right? I think it's quite interesting that at least a couple of you in the panel think that blockchain applications will really have the opportunity to really scale in some of these emerging markets. Yet we're starting to see sort of concentrations of a lot of these blockchain projects in very developed markets like, say, Switzerland, like Singapore, like Germany or Silicon Valley. Do you think that there's sort of like a talent gap between, I guess, where these startups and where the talent wants to be? They want to actually live in Switzerland or Germany versus where their applications will actually take off?
Also, I was actually just on an Asian roadshow, and one of the companies that participated with me, he was a former New York investment banker, and he moved to Africa. And he's developed a banking platform to have peer-to-peer banking in Nigeria. So I think that's going to be what you have to see happen to bypass the regulatory aspects, because he would not be able to do this in New York. People are liquid enough. The whole idea of micro-lending in New York, it's not going to scale, right? But you go to a country like Africa, take the tech that he developed with his team in New York and find individuals that have a direct usage for that. That makes a lot of sense. And I think it's going to be individuals that sacrifice that bit of personal comfort that we have here in the West to go to a relatively unregulated arena that you're going to see it scale from that angle.
Okay. All right, I think one of the other topics I want to touch on is kind of this idea of whether blockchain should be decentralized and permissionless or sort of permissioned. I mean, sort of from some aspects, I think blockchain really kind of took off. Bitcoin started out in 2008, 2009 as sort of this kind of new way of recording money, new way of transferring value that doesn't really rely on third parties. On the other hand, you have a lot of financial institutions like UBS, like Boney Mellon, like JP Morgan, all these guys sort of working to really push sort of using some aspect of distributed ledger technology of DLT within the organizations, which is still sort of to some extent a level of decentralization, but not sort of the ultimate peer-to-peer kind of original vision of Bitcoin. What do you guys think? Which will kind of be easier to take off, these fully decentralized networks or some of these permission-based networks that some institutions and corporations are pursuing?
Yeah.
For regulated entities, financial entities, definitely permissioned. Just for a regulatory perspective, but as well for them. I mean, it's already decentralized. So UBS, for example, is launching this USC, this utility settlement coin, where they are issuing £1 billion crypto pounds and depositing 1 billion with the Central Bank of England. And then they're settling interbank within the consortia with this crypto pound. And it doesn't make sense to open up to a public blockchain. It's just for them. It's already decentralized within the companies, but it doesn't make sense. And you need to have kind of an ability that you can change transactions as well if they fulfill all the requirements, because still it's a human business. You have a lot of mistakes, errors in the process, so you need to be able to solve those issues as well.
I think you have these use cases, but on the other hand, I remember the old days in the internet, I don't know, back in 1996 or so, where you had AOL, CompuServe, and all these services, and they wanted to create like a better internet by selecting the information, and it was interesting to see that literally all these players disappeared. Now it's a chaotic internet, but I think the difference is in this regulated surrounding, you just have the rules and the laws. But I think in general, if you don't have this, let's say, customer protection or other regulations which somehow have power which is far beyond the technology which is undermined, I think the non-controlled surroundings are always winning the game, because ultimately we saw it already in the tech space. It's extremely difficult to really preserve or control a technology which is originally made to run out of control, right? Especially when we have the self-running organizations replacing governments in the future. It will be an exciting time.
So actually, to build up on that, I mean, you brought up the internet in the 90s, right? I think that you created your first startup in the 90s as well, a internet-based startup. I think I'm going to throw out a point out here, and you guys can see if you agree with me or not. Because if you look at the base technology of the internet, the TCP/IP protocol, the protocol itself is meant to be decentralized, and anybody can spin up their own server on their computer. You can run like email, for example. There's nothing stopping me from hosting my own email server on my laptop and having emails come directly to me instead of through Gmail or through Yahoo Mail or anything like that. So like TCP/IP, the technology itself is decentralized, but then it really got mainstream because a lot of these sort of more centralized services like Facebook, like Gmail, like Google, made it a lot easier for the average person to be able to take advantage of the services of the internet. Now, I have a thesis, I have a hypothesis that the same will be true for a blockchain, that even though sort of there's a lot of discussion about the benefits of sort of blockchain being a decentralized technology, like the underlying protocol can be decentralized, but like the internet, you will need sort of some, let's say, custodial services, something like Coinbase, some of these exchanges, some of these sort of still centralized services to really make blockchain more accessible to the masses, whether the masses mean retail investors or traditional companies, small businesses, and so forth. Do you guys agree with that viewpoint or not?
I think it's an interesting perspective. Honestly, I mean, nobody really cared about the HTTP protocol. And I think we're in a similar situation at the moment right now, because honestly, the end customer doesn't care about the technology behind the blockchain or the underlying currencies. So I think as soon as we reach a level, and normally this level is reached when you have players plugging their services on the technology, but the end customer doesn't really realize what's happening behind, then we have these first real use cases. And I think that's a good example with all these email providers, right? I mean, after you realized how easy it is to replace your postal letters via an email, you just switched into this new world, right? Because there was a real use case with an added value.
I think the biggest thing we have to define here is that there's trust in blockchain. Where in a TCP/IP, there's not, right? Your server can be hacked really quickly and very easily by anybody that halfway knows how to code. That can't happen with a secure blockchain server, right? Then the other angle to this is the UIs that the Googles, the Facebooks were able to create on top of this. And the trust factor that Facebook and Google initially had, which has kind of eroded over the last couple of years. It's all about creating that trust layer that you can have access and secured rights to that data. And this is the use case that blockchain is able to have, because that email server on chain will not be able to be hacked. And this is a question of should it be public or this permissioned chain for an email, for instance, in this use case. So you would have that permissioned email access that only you and your internal parties that you give that permission to have access to do that. And it's a purely secured platform.
So taking that example, right, I mean, Google, for example, they started being a search engine in 96, 97, and they only really started storing customer data when you got to 2004 or so when they launched Gmail. Does this mean that you will need sort of some of these services, a similar kind of time frame, like 6 to 8 years, to really gain consumer trust, to really sort of have people start using some of these like less trusted kind of applications before they develop the trust to actually store more data onto these services?
I think just the tech space has become infinitely more progressive and more nimble than what we had in the early 2000s, simply because you have a lot better technicians, you have a lot of people that are going to school, and a larger talent pool to help develop this. So I think that we will move relatively quicker. I do think it will take time for some companies to build those layers on top of the blockchain to create those trust access points for us to be able to create those UIs, UXs for these individual use cases. But I think it will move relatively quicker.
I really like the example of the internet. That's what I bring always as well. We're in the early stage of the internet, 94, 96. I remember when my dad bought the first modem, and we connected the internet with the noise, and it was like 16 francs an hour to surf in it. And yeah, I set up an email address, but no one was really sure what the email is for. I can use a fax or a telephone or a letter, and then the same with websites. I have a physical store. Why do I need an online presence? And this kind of imagination we are applying right now as well, but now we need to develop the technology and deliver on our promises of all the ICOs or all the startups that they really can. I mean, they're always talking about multi-billion industries, but now they need to prove that they're delivering an advantage compared to the current system, and that they're really able to deliver that to the public. And again, with the internet, at the beginning you had to buy a modem for every computer, and then the manufacturer started to build the modem in the computer. Now almost every device has a modem chip in it, so every device is connected to the internet in one or the other way. That's exactly how everything will work with the blockchain as well. And most of the people will not realize that they're using the blockchain in the future. But at least for a banking perspective, the banks will apply the blockchain technologies and tokenize assets and shares and everything. And you will see it still in your online banking, in your portfolio. But in the back, everything is done with blockchain.
So taking that analogy, right, I mean, you're talking about internet in the 90s, like 9,600 bits per second and so forth. I mean, if you sort of have the technology at that kind of stage, you can't have a YouTube, you can't have an Uber because the internet is simply too slow at that point. Right now, there's a lot of talk about scalability, about sharding, about TPS, about things like that. Do you think that's also the case for blockchain? That's sort of right now the underlying infrastructure is simply kind of like the internet with a slow dial-up modem, that a lot of these amazing apps still cannot be supported yet because the underlying infrastructure still needs to catch up to the demands of the network?
I think it's a balance. For example, exchange like Binance, they can process a heap amount of transactions per second, but a decentralized exchange where we know everything's heading towards, it can't cater for that. So I think eventually it will go decentralized, but right now the more efficient method and what makes sense is centralized.
No, but I absolutely agree. I'm really convinced we need to develop the whole technology further. It's just a matter of time. And I mean, there are several, as you mentioned, there's several approaches to it. And that's needed. Right now, we're running on a 600K speed.
Yep.
Yeah, and ultimately, I think, these business cases, they have to evolve, right? I mean, sometimes I have the impression people look at this whole blockchain thing and then they say, oh, now you had your 3 years and it's not kicking off. I mean, it's a little bit like if you would go back 20 years from now and you look at these guys with their modems and then you say, hey, you can't even send a video clip to your friend, so email is bullshit, right? So I think we really have to be, so sometimes you just adapt the same developments. I think the difference is that the whole industry raised far more money than most other technologies before. So there's also certain pressure. And as you also mentioned, I mean, now having more serious investors joining the whole space, that also helps because I would say so far there was not that much smart money involved. And the side effect normally is that you also have not that many smart projects which were funded. So I think that's now changing.
Yeah, I think on one hand, right, I mean, you say that like it's great to have more of this institutional money, for example, smart money into the industry. On the other hand, we're at 250 billion market cap. A lot of projects have raised, to be quite frank, more money than they know what to do with. Do you really think that more institutional money is going to really help these projects at this stage, or do they just need the time to really actually build out their use cases?
Do you trust they're going to build out their use case? if we're going to be honest, right? I mean, you have companies raising 100 million, 200 million, even companies that raise 10 million. When's the last time you as a VC gave a company that had an idea and 3 team members...
Angel stage company.
Exactly,
right?
$10 million. It's ridiculous. It's something that has to change, and that's something that we're working on doing with Iconiq. At the end of the day, it's all about determining what liquidity levels these companies need to deliver on what they're promising. And this is where I actually see a good use case in institutional money, because that's smart money that knows how to hold these teams accountable. Because there will be term sheets with these ICOs. Companies will have to be able to deliver what they say they will in a reasonable amount of time, or that money will have to go back. The retail element might be able to institute this with the DICO, as long as the DICO is able to figure out its flexibility issues over the long term. But you're going to have to see this smart money coming into the place to hold these management teams accountable to deliver. So that's where I do see a use case for institutional money to become involved.
Yeah, and honestly, I mean, these white papers are becoming more and more traditional business plans, which is great. I mean, when you look at the vestings, for example, I would say in the early days, there was literally no vesting. You just take the tokens and the founders sell them and start the next ICO. And now you really have 2, 3, I even saw in our case with 4 years vesting, so that's now becoming really close to the traditional term sheet of a VC. And I think that's a good thing. I mean, there's, I think, a certain reason why there's an industry which put money into successful companies in the last 40, 30 years, that there are some rules and some behaviors which seem to be right to fund companies, and normally you give a little bit of money, you do big mistakes with a little bit of money and you learn and adapt, and today it's the opposite, right? You do, with a lot of money, you do a lot of big mistakes, and that's perhaps not the way how you should support emerging entrepreneurs.
I think we should stick to the traditional VC approach, right? That you have kind of staged funding, and that you, in this case now, you need kind of an escrow agent to release new funds to the team as soon as they have delivered on certain milestones. And what no one should forget who is doing an ICO is money is one thing. but VCs can bring you as well their network, their experience, and so on. So even if you have $100 million, it's not that you have now access to everyone and that you kind of ship around all the obstacles you have as a startup.
I think there's two use cases long-term for an ICO, and I'm not necessarily sure where it's going to carve itself out. One is that companies that have gone through multiple financing rounds, your post-seed, Series A, Series B, and then maybe they do an ICO instead of an IPO. And then you have a publicly traded asset. Basically, you can just do a reverse ICO in this regard. I believe long-term, the ICO has a unique use case to carve itself out as a Series A financing round, something in the ticket size of 5 to 10 million. I believe that a lot of these companies need a VC upfront. They need that liquid investment on their cap table. They need that ability to develop that 6 to 9 month runway to get their technology working, to get their go-to-market strategy finalized.
MVP.
Exactly. So every company that applies to Iconiq Lab, if we love the idea, but they're not ready to do an ICO, I connect them to VCs that we know. Say, hey, go here, talk to these guys, get their financing, get them on your cap table. We'll then help you get to that next stage of your evolution by providing that bridge financing to do the ICO and then help structure the token sale. And this creates what is effectively better KPIs at that Series A financing round with a non-dilutive financing instrument to then have later stage, that Series B, Series C financing round. And this is where I believe long-term ICOs will carve a niche for themselves.
Mm-hmm. But how do the VCs invest in the company in a seed round? Traditional equity?
Traditional equity. Or there's the new thing in the US, the safety.
Yeah, but I think we need kind of a new process that you have several kind of tokens you distribute, the seed token and so on, or kind of issue a larger one.
There could be that, but I don't necessarily agree that the retail element will abide by this, because they're not. The retail element isn't necessarily educated in this. They'll see, oh, this company is just issuing new tokens, I'm being diluted. They don't have the ability to process that, oh, yes, you're being diluted, but at a higher valuation of the token. Mm. They just see, oh, I have less of the pie.
Yeah, but still, I think you need to come a little bit away from this traditional equity investing and more into a coin offering for the whole life cycle of the company.
It depends on the use case. So if it's a cryptocurrency, a protocol, I would absolutely agree. But I am a large proponent of there still being an equity backing behind the company itself. And the reason being is because the management team still needs to be incentivized to deliver value to the platform or the dApp that they've created. And I'm perfectly fine having an equity structure behind that token instrument that is supporting this. Yeah.
Absolutely. No, it's just ridiculous what you get as an early investor with an ICO, right? Nothing. Yep. If they're very successful and they sell their company to a large company, after 1 year, the token is still useless or worthless, but they make a lot of money and you don't get anything normally with such a token sale.
Well, it depends. So the way that we structure a lot of our token sales is that the tokens get distributed to the team pro rata based on the cap table holding. So from a VC's perspective, if the token's able to deliver the value it's supposed to, you actually are getting 1 to 2x off of your initial equity investment right away with a liquid instrument. In addition to that, you also have the working capital adjustment for the financing that was raised. So realistically, your value that you put into the company early is actually now more at 10x. And then from that, you have better KPIs and better usage data to be able to go to your Series B, Series C financing round to help grow and scale that company more. Now, I would love to do secondary token offerings. The problem is that's not necessarily tested in the marketplace yet.
You don't need to. You don't need to. But so it seems like your approach is kind of a reference approach, and I think that's going to be the future, and that's very necessary that we have such an approach for all the ICOs.
Well, but you might actually need it, though, because that ICO, if it raises 10 million, if this company, whatever its use case might be, wants to scale globally, they might need a 50 million round, a 100 million round at a later stage. The question is how do you raise that financing? Is it through a releasing of a secondary token offering? Is it through a cap table investment? Is it through a reverse ICO? We haven't answered these questions yet because no ICO is really delivered to get to that point where they need that additional financing round, if we're going to be honest.
You already have enough.
Some of them do.
It's interesting. I mean, like last year, there was all this talk about ICOs basically disrupting the whole VC model, like basically getting rid of the need to pitch to like VCs for 6 months and traditional sort of value financing. But now it almost sounds like you're advocating a more responsible approach for these token sales, is to maybe sort of push off the retail component to maybe later do some sort of Series A, Series B kind of tranched rounds. Yep. And it almost sounds like you're reverting back to the old model of of financing, where sort of you do private rounds with investors every 18 months or something like that, and then don't go public until sort of you're ready and your product is out, and so forth. So if that's the case, how much have ICO, like if we're reverting back to this model, then how disruptive really is ICO, besides sort of this little big boom and bust that we may have these couple of years?
But I think the underlying key elements of a successful company, as an entrepreneur myself, is the team, the founders behind. And it absolutely doesn't change anything that you raise 20 times the money you would need in a far faster and more convenient way. You're still not a better entrepreneur, right? And I think that's something more and more people are also now realizing. Just because you do an ICO, you're not becoming suddenly a successful entrepreneur, and your shitty idea is suddenly becoming the next big thing. And I think that's one of the key components, that you have a different wrapper, you have far more opportunities. I mean, you can tokenize the equity, so you, at the end, both are right? So you still have equity, but it's tokenized. But underlying and the success of every company has nothing to do with an ICO or the way how you raise money. I think one of the advantages is that the founders can really focus on their business, so they don't spend too much time to meet VCs and doing roadshows or whatever. But when you look at events like that, you think they have nothing else to do than just to have booths and pitches to pitch in front of investors. But I think at the end it's all about the people behind, right?
See, I'll actually jump in there, and I'll say this. So you said that it takes 6 months to raise from a VC, and it's a roadshow. You have to meet with a whole bunch of them. What has evolved in the ICO space over the last year or so is that back in 2016, back in early 2017, you could do an ICO, have a good UI, did a little bit of a marketing campaign, maybe spend 50K, and you could raise a few million from a retail element. Very, very easy to do. It's completely shifted nowadays, where you're still now doing that 6 to 9 month roadshow to be able to place the strategic investment, the institutional investment into your own ICO, and this is completely irrespective of the public and the retail element. Because what you're seeing now is every major ICO that's raising has done so entirely through institutional and family office money. Most of them are only having a very small portion that is actually sold to a retail element, and even those that raise enough from the institutional rounds, they're just flat out canceling the retail sale just because there's a lot more regulatory risk involved with it and they just don't need the additional money. So the idea that it's easier to do an ICO today than it was to raise from a traditional VC has completely gone out the window. Sorry to everyone that's doing an ICO in the crowd. It's just not the case anymore.
I think as well, some of the ICOs have realized that their kind of ICO, pre-ICO is equal to post-ICO. So whatever they invest in marketing before, it's like with an IPO, right? You need to inform your stakeholders, your shareholders, and so on. So it's a lot of work. And as soon as your token is traded on exchange, there's not only one direction, but there are two. There's a downside risk, which can infect your business quite intensively. So sometimes it's better you have some few strategic investors. They stay with you. They understand the business model and they support you as well through hard times. And then later on, if you're really ready to deliver, you go public properly.
Couldn't agree more.
I think that's quite interesting. I think kind of over the course of this discussion, we've kind of had this route where ICOs probably had a big blip in the past year or two, where there's a brief window where it was much easier to raise money than it used to be with traditional models. But right now we're slowly kind of reverting back to where it takes the same amount of time, it takes the same amount of effort. You may sort of still raise more money than traditional VCs, but even that is declining, and maybe it will normalize back to sort of where there's not a significant advantage to the sort of amount of money that you can raise through ICO versus traditional VCs anymore. And like getting back to the original question of getting blockchain investments mainstream, it almost seems like that at the end of the day, like Mark said, it's not about how much money you raise. It's not about the mechanics of the way you raise money. At the end of the day, an ICO is just a tool. Blockchain technology is just a tool, like almost to sort of get these use cases off the ground, to get these startups off the ground. It's good old-fashioned hard work. It's good old-fashioned, just like the same amount of work, the same amount of skills and hiring and pivoting and sort of business marketing that it took for all the internet giants back in the 90s to really get to where they are. It seems that that's one of the key things that a lot of these projects just need to get back to work, build out the use cases for these projects to really go mainstream.
Well, the biggest issue right now entirely in the crypto space is a lack of leadership. You have a lot of technologists, a lot of people that know how to build very interesting technology, but there are no leaders, no true business, I shouldn't say no, but there's very limited leaders and business developers in this space. Those people that are able to be a benchmark for what should be execution and delivery.
And do you think these will need time to be, like this kind of talent needs time to be developed from within, or should the industry be trying to attract more of these leaders from outside the industry?
I think both. I think there's a very good use case in taking these native technologists and helping educate them on best practices in business management and business development. Also, I think it's a good use case for us to take external individuals, those that have their backgrounds in MBAs, that understand how to utilize technology to address the needs of end users. And there needs to be a collaboration between those two communities such that we're able to push this to the next evolution of what blockchain can be.
But I think that's as well an advantage of the ICOs, that they raise a lot of money so they can as well hire some very good people from other tech industries.
Yep.
So who went through the whole internet's time and made companies very successful, that they can take them now into the crypto space or blockchain space and help them build their company. I think that's very important as well.
Yes.
But do you think, I mean, there are some projects that sort of, like you said, their business plans just look quite similar to traditional companies. And in this case, I would argue that it's quite easy for some of these existing tech executives to come in and sort of replicate what they've done. But with some of the more, say, decentralized business models, like the DAOs and sort of these new governance models that are really coming out of blockchain tech, do you think this existing talent will really be able to adapt to be successful in these kind of new governance models?
I think ultimately you always have to have a model behind, right?
Yeah.
I mean, it would be nice to have an altruistic world, but that's just not the reality. So you always need to have certain triggers and elements. I mean, the interesting thing is that the tech guys, the geeks, are now, at least most of them from the early days, they're completely independent. I mean, in the past you had a business guy and then normally he hired some tech guys, so it was like business drives tech. And I think in the whole blockchain space you have quite a few players there. Financial-wise, they don't have to care about anything anymore, so they can really focus on their tech stream. And that's something I think which will bring quite a few quite astonishing ideas to the market, which are normally, because it's more business-driven, perhaps not possible.
All right, we've just got a few minutes left, so we can probably take one or two questions from the audience if anyone is interested. Do we have anyone with microphones? There's one here.
Like this?
Yes.
It works.
It works.
Like seriously, this is a microphone for a
Everybody
serious
can hear you,
conference
it's
like
fine.
this one.
Everything's
Right.
blocked here.
Please introduce yourself as well.
All right, my name is Emanuele Francioni, and I am the CEO and founder of Web3 Ventures and X2X blockchain, which is basically a privacy-oriented coin that uses a completely different consensus methodology and yada yada. But basically, when it gets to investments mainstream, there is something that I really didn't hear here, which I believe that is probably an enabler, a property of blockchain or cryptocurrency, which I would like to hear a little more, if it is or not an enabler, which is privacy. I mean, a lot of different things that are going on blockchain, for example, a smart contract, they normally go on a very public ledger, and everything else, which is, a privacy coin right now, get a little bit stigmatized for, just permitting or allowing all sorts of crazy things. However, it is also true that at this particular point in time, if I'm having a bank transaction or if I am having a real estate transaction, I normally do not really want anybody else to know what I am doing. So how how important is this to enable, just...
Well, I think that's where private permission blockchains make sense, right?
Or even
Yeah.
like
Do you mean
Starks
permissioned? You mean permissioned as in
Also, so
contrary as
only
permissionless?
individuals that have a use case for that data, it's not a public ledger, but it's a permissioned ledger. Only those that have the use case for the data and only those that have the ability to see that. And maybe it's because it's a regulated environment, which real estate would be. That's where you have that ability to be private, rather than having it fully
So you
distributed
wouldn't
public.
put real estate on a permissionless blockchain. Is that what you're saying?
No, on a permissioned blockchain.
You would put it on a permissioned.
No, I'm saying that would be one use case. I don't know what it should be. Basically because you could have it fully public, but then everyone will be able to see where your houses are, and you might not want that.
And probably something like Monero or even X2X, which
You
is
mean money laundering?
permissionless, is yeah, that is exactly what I'm saying. I mean, anytime that these privacy coins just are mentioned, then everybody speak about money laundering. But is
Yeah, but there's a
permission basically
difference.
the solution there?
Yeah.
There's a difference between the two of them, because one is only participants know what it is on the ledger and who has what, and the other is no one knows where and who the transactions goes, right? For real estate, you need to have some parties who can control or see the transactions and regulate them.
And I think
Unless you share your view key with somebody else, you mean? Because with a view key, you can actually see what happens.
because at the end of the day, when you're talking about real estate is land which is still governed by government. So you still need some sort of tie with the real world as well. So it may be like real estate specifically might be more difficult to be fully private even from the government. But there are probably other assets that can benefit from like Monero or Ziki Snarks or some of these.
Yeah. Especially because real estate's taxed.
Yeah. Sorry, I think that's all the time we have. I'd like to thank my esteemed panel again. This was a very, very interesting discussion. I think that we were able to view a lot of the different kind of perspectives, a lot of the different barriers to getting blockchain mainstream. So thank you very much for sharing all your viewpoints today. Really
Thank you, Rem.
Thank you very much.
Thank you.